Good afternoon and welcome to the Asian Midday Market Watch. Our guest today is Vishnu Varathan, Head of Economics and Strategy at Mizuho Bank, coming out of Singapore. Now, Vishnu, great to have you on the show on Monday.
Thank you for having me, Brian. It's always a pleasure to be here.
Now, before we get your insights, let's first take a look at how crypto markets are performing. We're starting with Bitcoin, which is at 46,133. It's down 0.56%. Ethereum is at 3,504.52. It's up 0.84%. Now, looking across to regional stock markets, Chinese markets are closed today for the holidays. So we start with the SGX, which is at 3,424.53. It's up 0.16%. If we look at the KLSC, that's at 1,598.51. It's down 0.24%. The ASX All Ordinaries, it's at 7,830. It's up 0.57%. The Nikkei is at 27,692.5. It's up 0.11%. The Hang Seng is at 22,323. It's up 1.28%. And rounding up the numbers, we've got the Kospi, which is at 2,749.13. It's up 0.34%. Now, Vishnu, what's your view on how markets have performed in the first half of the day?
Well, on a relative basis, I think there seems to be some relief. Some might even characterize this as a very mild risk on, but at least the very least we can say is that markets are not in a state of panic, and I think a few things could have helped here. I think they are probably, despite the horrors of Ukraine and as the withdrawal of the troops from the outskirts of Kiev, revealing the kind of devastation. Despite that, I think markets are hoping that the ongoing talks between Ukraine and Russia may give rise to some relief. That's one. The other is oil prices have softened, but are not hugely volatile. So they are stable and softer, not absolutely eroding either. But that is giving rise to a little bit of a Goldilocks scenario where there's some consolation from the US release of strategic reserves. And I think the confluence of these factors with a very strong US jobs data is showing very solid recovery, with unemployment falling to 3.6% from 3.8%, expectations for 3.7%. So that also shows that the US economic recovery is not giving way. So that has given rise to some cautious risk taking in the markets. However, I think this week markets will remain very focused on what's going to happen with the FOMC minutes. These are backward looking, yes, but they'll still be very interested to know the details of the discussion that went behind the March FOMC that saw a huge upward revision to rate hikes for 2022 from a median of 3 hikes to 7 hikes for the year. So those are some of the things markets are looking at. And I think if we want to sum this up, we'll just say, look, it's cautious optimism, if not relief, depending on how we look at it.
But one of the key things that worries markets, obviously, is bond yields are continuing to rise. And obviously, the risk of a hard landing for the US economy gets closer and closer, because today, the 2-year yields were up to 3-year highs of 2.49. Now, that's well above the 10-year 2.41 that is now forecast. So what's your view on this?
Yeah, I mean, that's a good point, Ryan. So before I get into the chart and looking at things, the one thing to take away here, the two things so one thing is the two things that markets are worried about. So here's the 1-2. The two things that markets are worried about is A, the speed of movements in yields. So you're right, 2-year yields have gone up very rapidly. And if you look at the speed at which they've moved up, that's tremendous. So they are worried about very aggressive moves that can lead to some shocks in the market. That's one. The other is what typically markets would look at is the curve, the so-called shape of the yield curve. An inverted yield curve, which is what you alluded to, 2-year yields going higher than 10-year yields. Let's say you don't get any premium for holding the investment for longer, which is very odd. And typically markets associate this with an impending recession. They take it as a harbinger of a recession. So, but
often that's a 1-year time lag, isn't it, in terms of without it being an inexact science, but historically it's been about a 1-year time lag.
as you rightly alluded, is the inexact is a very kind term for it. Some might say it's dabbling in the dark arts. But we can draw generic relationships. So that one interesting thing that we note is this tends to happen. So if you look at the blue line here, the blue line is showing us that the difference between 10-year yields and 2-year yields. And it's on an inverted axis. That's to say, 10-year yields are higher than 2-year yields here, and they are lower than 2-year yields here. So this is where you get inverted. And the green line is the Fed's policy rate. So you see, whenever the Fed starts hiking, the initial phase heads towards a flatter yield curve. In some instances, an inversion. We've hit an inversion now, and that sort of makes sense because if you expect the Fed to hike rates aggressively, the front end of the yield curve is a lot more sensitive and moves up much faster, whereas the long end of the yield curve tends to get subdued because they expect the Fed's hawkish actions to temper down inflation as well as activity. And that can be shown in another way here. You can see that the blue line here is 2-year yields. The red line here is the 10-year yields. And you can see how quickly 2-year yields have caught up with the 10-year yields because of this projected rate hikes. Markets are projecting a very aggressive rate hike. And the main takeaway here is, does this mean that now there are greater risk of policy miscalculation? Definitely, because it becomes harder to balance between actions leading to a hard landing versus containing inflation. But does this mean that we are bound for a recession for sure? Certainly not, because there's still a lot of distortions in the market, especially looking at the huge Fed balance sheet where they've bought a lot of bonds. That's distorting liquidity in the market. So we need to look through these things. But I think it doesn't matter which way we go. Markets will definitely be watching very closely how the Fed reacts to inflation and growth dynamics as this picture unfolds. And even as the Fed went from 3 to 7 rate hikes in just a period of 3 months, from December to March, we want to note that markets went from 7 to about 10 rate hikes, and that's super aggressive for this year.
Now, Vishnu, then I want to take a look then at Europe, because there's a couple of things clouding it. Obviously, the Ukraine situation, and now with the threat of further sanctions on Russia. And the ECB obviously having the problem of tightening or basically raising rates because inflation has reared its ugly head in record rates. What's your view on the policy tools that they have available to them right now?
Yeah, I think the ECB is in a much tougher place because their brand of inflation, which you correctly pointed out, a lot of it coming from energy shocks, is directly related to something that's going to destroy demand. So that inflation is definitely going to destroy demand. And so the ECB is in an uncomfortable place where they need to tighten policy, even despite knowing that this is going to lead to demand destruction. And so they need to I think navigate this very carefully. One thing they could do is manage their liquidity programs, including their balance sheet programs. The other thing is rate hikes, but they're definitely not going to take an aggressive a cycle as the Fed. They're going to do this a lot more in a lot more of a measured fashion, as ECB's chief Lagarde has suggested. But nevertheless, they are in caught between a rock and a hard place. And the outcomes for the Eurozone economy are going to be more suboptimal, given that they don't have the growth buffer that the US has.
Now, Vishnu, looking ahead this week, what are key data points and events that we should watch out for that could move markets?
So as we alluded to earlier, we've got the Fed's minutes for the March meeting. That's one. The ECB is also releasing the details of its March meeting. So these are two big central banks to watch for what was discussed in the details. For the Fed, I think a lot of attention will be paid to the precise discussion on quantitative tightening or balance sheet runoff, because Fed Powell did say they've gone some way with that. So that would be the interesting point there. For the ECB would be whether they explored any policy options or not. In our region, we've got two central banks meeting. Tomorrow, we've got the RBA, the Reserve Bank of Australia meeting. It'll be interesting to see what they do. I think it's accepted that they will not do anything, but so I correct myself. It'll be interesting to see what they say about how soon they may want to advance their tightening, because they were initially not inclined to do so until very late this year or early next. They might bring it forward a little bit. The one on the hot seat is the RBI, the Reserve Bank of India. Inflation has already gone past their threshold of 6%. But the RBI, I think, remains quite circumspect about tightening policy given they're trying to support growth. They're running out of time. It's a very narrow window. So if they hold this time around, pressures will increase for them to take action. So in the interim, there could be some pressures on the rupee if things don't pan out, especially if oil prices start going higher again.
Now, Vishnu, as always, thank you very much for taking your time to come on the show.
My pleasure. Thank you for having me, Brian.
Now, we've been speaking to Vishnu Varathan, Head of Economics and Strategy at Mizuho Bank, on Biztech's Asian Midday Market Watch, powered by Rajhi Bank, Malaysia. I'm Brian Fernandez. This video will be on our various social media platforms as well as our website, www.biztech.asia. Please like and subscribe to our various platforms. Thank you very much for tuning in.